Hello, everyone. Thank you so much for joining us for our second quarter Lunch and Learn. My name is Jeremy Cronemeyer. I'll be your host for today's webinar. I'm the operations manager here for Wickham Financial Group. And then I also have with us Graham Wickham, president and CEO of Wickham Financial and Insurance Services. Graham, I'll let you take it away, man.
Yeah, thank you, Jeremy. And thanks for our listeners being on the call. And before we get too deep into this, I got to apologize. I think the summer has blessed me with a summer cold. So bear with me if I got a cough, grab a drink of water, or sound a little nasally here. I appreciate your patience as we work through the call. But I think it was pretty important to kind of just have a mid-year kind of review of what's going on in the market. Let's kind of look at how the indices have performed, right? What's working, what's not working. I'm going to bring in a couple articles from Jim Paulson, who puts out the Paulson perspective. He's an economist. And the reason why is I know everyone always hears what we have to say, but I want you to hear what an economist that we think is mindful, thoughtful about the market, and truly respected, what they're seeing and what he's seeing in terms of what's going on. Because we get a lot of questions about the bull market, right? And how long can it go? Has it gone too high? So on and so forth. We get a lot of questions, and we even have questions about the concentration of this market. Is it normal? Is it abnormal? What should we expect from that? And then we'll kind of get into some end of the year expectations. I mean, obviously we got elections coming up. We got the Fed that we have to deal with. We got earnings from companies, so on and so forth. So how could the rest of this year unfold, and what sectors may be apt to benefit? So we'll kind of spend some time going into that. Last but not least, we'll give at least 5 minutes. Jeremy will jump in here if I'm running a little long in the tooth of my explanation on things, to kind of give us at least 5 minutes for some questions and answers. So I love to start thinking about some things. You can always chime in under those comments, and Jeremy will bring those questions up at the end of the call. But let's jump in with kind of where we're at a little bit. We're looking at the S&P up about 14.5%. We see the Dow Jones Industrial up about 3.9%. Now, I'm going to get into these differences here in a minute because they're huge. The NASDAQ tech-focused area up about 18%. Last but not least, I wanted to bring in something as kind of a wow, if you might. If you look at what's called the equal-weighted S&P, that's only up 3.61%. Now, I didn't bring in the Russell and all that other stuff, which have underperformed even the equal weight. But let's go back and kind of define a little bit here real quick how the S&P is calculated in terms of what weighting certain companies hold in that index. There's 500 companies that make up the S&P index of multiple sectors within the U.S. economy, from large to small, mostly large. And what it is, it's called a cap-weighted index. So the largest companies make up a larger weighting of the index. So let's think, you always hear the term like the Mag 7, things like that. So Apple, Microsoft, now NVIDIA, $3 trillion club. Listen, they're making up 6-7% respectively of that index. If you throw those Mag 7 in there, the largest 7 companies, I think that, I didn't look at it today, but I think it's making up 26 to 28% of the S&P index, right? So that holds a large weighting. The rest of the 493 are not less important, but it's not as large, right? But if we look at the Dow Jones, it's not a cap-weighted index. It is what's called a price-weighted index. So the higher the price per share of the company that's in the 30 stocks that make up the Dow Jones compared to 500 in the S&P, hold a larger weighting. Now, the NASDAQ's different than that. It's just really tech-focused. So when I say the equal-weighted, what that is saying, and this is going to come back in the articles with Jim here in a minute, is that if we looked at the S&P 500 and said everything had the same weighting, that's what we're talking about when I'm talking about the equal-weighted S&P. So think about this. In a cap-weighted S&P index, the normal index that we follow, where we got about 28% exposure in those 7 stocks, the majority is made up of those 3 largest $3 trillion companies. It's a 14.6%. You flick over to the equal weight, it's only up 3.6. You can see the dominance and the concentration that's going on in the index that has to do with AI. It has to do with technology, and that's what's still driving the market. That's still what's been the leadership so far. So let's go into leadership. What's worked and what's not worked year to date. All right. So technology, just like I said, that's what leads the NASDAQ. That's why it's up 18%. The S&P is up, 14 and change. If we broke out technology compared to growth over value and all that, we'd even be looking at different numbers. But let's look at what's been the outperformers. We got technology up about 15, 14 for retail services, 13 on down the line. Now, if we get to what has not been the best performers, now the utilities gave up a good bit, energy gave up a good bit, because at one point, at least utilities were leading at one point. Now they're up about 4.25 in aggregate, so far this year, where we might see like energy, off a good bit, but the real lagger here is going to be consumer non-cyclicals, and then probably the next leader, and so on and so forth. Of the laggards might be the financials and conglomerates. So kind of how we had last year is kind of what's leading this year, even though we are getting a bit of a catch up, and we were expecting that coming into this year. But we'll get into that in a good bit more detail later. But let's jump into Jim Paulson's comments. I think he puts out some very insightful, some very intelligent articles. Sometimes he gets a little bit in the weeds, so bear with him as I get a little bit in the weeds on these things. But kind of read between the lines a little bit here is that we're trying to impress upon, certain things like this bull market run. Are we concerned about the concentration? How does Jim feel about that? How do we feel about that? How can the markets handle that going forward? So let's jump into this first article. We got the bull market checkup that Jim put out there. Now let's think about that. We have bull markets in different periods, right, over time, right? So we've had 12 post-war bull markets, right? That's positive movement up in the exchanges, right? Or let's just say in the S&P index for right now. That lasted on average about 5.2 years with a median of about 4.6 years. Now think about this. This bull market that we're in now, that we started last year, is up about, I think we're about a year and a half in, about 383 days. Now, of the 8 previous bull markets, Jim points out they lasted another 2 years longer with an annualized average annual return of 12.1%. So I think you kind of get what Jim's getting at, is that this is a pretty short bull market that we're in right now. If we compare it to other bull markets since World War II, and again, we've had 13, look at this red line over here. Excuse me, we're up, we're at 383. Jump over here to 1987. That was 3,109, or in 2009, that was 2,700 rough days of trading. So again, no guarantee we're going to hit some of those more lofty levels or extend another 2 years. But the point is, I think we're still young in this bull market, and Jim does a great job of pointing that out. Now, let's look at this bull market and what are some of the outliers, right? So I think with the interest rates and how interest rates moved up so fast, so quick, it created some winners in this market. Excuse me. It also created some underperformers. So in most bull markets, you usually see lower bond yields. You usually see some lower interest rates. Why? Borrowing cost is down. It spurs the buying of goods and services. It leads to profits and revenues. That's higher earnings for companies, so on and so forth. The market goes up, right? Well, this has been a little bit different. We got a strong consumer, we have a strong economy, and we have strong earnings. So what's going on? Well, the tech sector's left. One, because I think we're in a change like the internet. We're moving to generative AI. And with the tech sector, a lot of these largest companies don't need to go to banks for loans. They got great cash flow, they got great earnings, they got money in the bank, and they got demand. And that's what's driving that sector right now. Now, what has happened? Well, we're pushing down equal weighted. The equal weighted side of the index is down. Remember, 3.61%. We're seeing small caps depressed. You can probably even drift over to international and also cyclicals. If we look at in today's stock market, is it overextended? Let's see what Jim's saying on that. So we see the rise in the S&P since last fall was fast and aggressive. Yeah, it was hard to even find a good entry point to get into this market. Most of it was catch up, though, from the bear market that we saw in 22. And we have some previous year bear markets that we caught up or rallied off of. So let's look at the current one. So the S&P is only up 5.6% above its previous all-time high. That's 28 months ago, and that ended in 2021. Excuse me. If we look at the average annual return, that was only 1.9%. That's pretty paltry, Jim's pointing out, over the last 28 months. If you look at average annual returns, and I think the number since 1926 might be the average annual return for the S&P around 10. So we've kind of made back a lot of what we corrected. And are we frothy? Are we overvalued? Arguably, maybe in certain sectors, maybe on a short-term basis, maybe not necessarily on a long-term basis. We'll have to see how all that works out. But I think Jim brings up some interesting points here. So here we're just charting it out and look at the correction periods. And think about this. When you're talking about a correction, it's about a 10% drop. When we're talking bear markets, that's 20%, right? So we're looking at 20% over in 2019. We're looking at about 34% in 2020, about a 20% in 2022. And then we had a little bit of a blip last year about summertime. But look, that span from 22 to today, about 5.6% move up on the S&P index. Let's dive in a little bit further. Is it abnormal to have these bear market collapses? It actually is abnormal to have so many in such a short amount of time, Jim's pointing out. Listen, we've had 3 bear markets, 20% drawdowns in as little as 5 years. Now, if we go back over the last 78 years, we've had 11 bear markets. That is a huge percentage, excuse me, in such a short amount of time. Now, I kind of added some words here to Jim's statements, but I called it the wall of worry, or kind of like, what is this market facing here? We still have a very depressed consumer right now. Consumer sentiment is not high. It's not everyone's euphoric. We do have some near record-setting money fund to disposable personal income ratios. We are seeing continued warnings from the Fed and the Fed speakers talking about inflation and how about their desire to maybe postpone or put off to try to get inflation down a little bit more. And we still have some persistent calls from some CEOs still calling for recessions that we do not and have not seen. Well, will we get a recession? Of course, we always do. It's just not right now. Excuse me. Let's look at some areas that maybe have underperformed here. Let's talk about small caps, that Russell 2000 index. That's nearly 18.5% below its record set that was in November of 21. If we look at the Russell 1000 value, not the growth side, but the value side, it's only 1.6% higher than in 22, its previous record highs, Jim is pointing out. We go international from developed, that's basically flat. It's at the same level. And emerging markets, Jim's pointing out, is that it's still 30% below its record high. So it's not like everything is running to new highs. You have some real underperformance. Let's jump into Article 2 before I collapse in a coughing fit here. So what is large cap concentration? How does that imply in terms of future returns? So let's take a peek at this. So now we're getting into the equal weight and the market weight, or the market cap weight. Remember what I talked about at the very beginning when we opened up the lunch and learn? I talked about the equal weight, right, on the S&P. Everything represents the same amount in the index compared to the largest company holding a larger percentage. Well, let's compare these. So the equal weight has underperformed the market capital weight index for the last 9 years. Among the largest and longest periods of relative underperformance since 1926. Now, the EW equal weight has underperformed the market cap weight MCW by about 25%. This lasted about 6 years, from 26 to 32 and 94 to 20. Now the equal weight was outdone by the market cap weight for almost 11 years between 46 and 57. Historically, there's nothing odd, Jim's pointing out, about the stock market leadership being very concentrated, right? Sure, is there a point that we want to consider this market to broaden out, to maybe pick up some of the areas that have underperformed? Absolutely. Over time, you're going to need to have that to have a healthy market. But what Jim's pointing out is not unusual. So during the last 100 years, the equal weight index has actually outperformed the market cap weighted index. Now, since 1926, both the market cap weighted and the equal weighted have enjoyed about 9 significant leadership cycles. So it comes and goes. So I guess the moral of the story that Jim's trying to get across is not abnormal, right? So let's say the market cap dominance appears quite normal, at least compared to the action over the last 100 years. Now, the U.S. stock market is nearing, and I think this is important, nearing possibly, and Jim's calling it out, nearing maybe a possibly new equal weighted leadership. So we've had a market cap weighted leadership of late in the recent years. Maybe it's time for an equal weighted, right? Remember, that's the side of the markets that have underperformed. And that might pick up with small caps, the equal weighted, maybe the value side of the market. Let's jump into kind of the last things I kind of want to go over. And that is, what do we see going on here that could derail? What are some things that we're facing for the rest of 24 here in terms of the market, how that may or may not affect the market? Now, we got some geopolitical events. I think what we're seeing over in the elections over in France, that is causing some adjustments in the international markets. That can always play a role. We're in an election year. It's always dramatic. Everyone has an opinion, right, on what direction things might go. Now, it's usually headlined. It's not going to be a long-term, and we'll look at some stats here and how that's going to affect the market. But it can be a day-to-day, week-to-week volatility issue. The Fed rate policy, are they going to stay higher for longer? Probably. Are they going to move into a period of maybe they need to reverse their pause and potentially lower to maybe raise? Now, I think that would be a big problem for this market, right? I don't think the market's really pricing that in, but I think we're still looking at inflation coming down. We'll look at some inflation figures, and it doesn't look like it is spiking. And then earnings. I think if we really had corporate earnings falling off instead of increasing, which we're expecting to increase, that could be an issue for this market, right? Because if earnings are coming down, then we got to question what multiples these stocks are trading at, and then it'd be harder to justify. So if you got interest rates coming down and you got earnings going up, that's a pretty healthy market. So let's look at geopolitical events and the S&P index. And that's generally what we call the market. When we go back to that, the S&P. So listen, over time, you can see this black line, the market's gone up. It might have periods of pause, but it doesn't matter. It's the dot-com, the Asian contagion, the bond market crisis, the financial crisis of 8-9. We look at wars, we look at pandemics, the market still trudges forward. Now, again, it might have periods of pause and digestion, but it still moves forward. If we look at election years, and I know everyone has a different opinion, and it's no guarantee that, the past is going to repeat itself. But it really hasn't caused much drama in the market. Think about this. The market just wants to know. The market is of businesses. It's of profits and revenues, right? It's trying to gauge or plan for the future. And as long as the market has an idea of what earnings are going to be or what political environment looks like, it can manage that. Again, opinions aside, it's just how it's worked out. So it doesn't matter which one of these charts that you're looking at, it's still a positive performance in the markets. If Republican, Democrat, split, majority, doesn't matter. Moral of the story is the market still trudges forward. And again, as long as inflation's in check, earnings are in check, the consumer can weaken a little bit, just not a lot. And we want to see an economy growing, not in a recession. That's all good for the market, right? Let's look what happens when the Fed. Remember, we talked about this. Some of these slides that we brought back in. When the Fed pauses, 1 year following the final Fed rate hike. Remember, the Fed paused in basically the summer or really the fall of last year, and the market took off, right? Or the bond market took off, and some of the more value side of the market, small caps. Now, they've kind of moderated a bit to this date, but that's what really took off. So if you start looking at core bonds, 1 year up 10%, 5 years later, look at the U.S. stocks up 16 or 9. Some of these numbers are pretty interesting because they're kind of tracking what's going on this year. If we look at the 60-40, that might be 60% stocks, 40% bonds. That was up 14 1 year, about 8.4%, 5 years following the final Fed hike. So I guess what you can gauge from this is, this is pretty good. When the Fed starts to say, listen, we're going to sit pat, we're going to weigh out, and then potentially lower, that's very good for the stock and bond market, barring other things being in place. Unless we've had inflation pulling back. Look, we're 9 and change in 2022. I think we're headline about just over 3% right now. If you strip out some more volatile areas, maybe housing or rent, I think there's arguably back down to the 2% range, but the target for the Fed is around 2%. Now, I've said from day one, this is the tough part for interest rates right now. They kind of get these lower levels. Last but not least, and again, I apologize for all my coughing here and sniffling, and hasn't sneezed yet. Hopefully won't. But let's look at what we think is going to happen. This is kind of what we're talking about in the end of the year. I think this is still going to happen. We already see it happening. It just hasn't been a huge, broad rally yet. But we think the haves are just going to moderate a little bit because they've done so well. People are going to take some profits, and they're going to look at the underperformers. So where are those underperformers, or what we're calling the opportunity here? That could be in bonds. We know how well bonds do in a flat to dropping or lowering interest rate environment. They do quite well. You get paid great on bonds. Now I think we're opening ourselves up for a capital appreciation. So increasing that duration, the length of those bonds from those money funds, right, can help out. Also think about this, $4 trillion in money funds. What's going to happen to that money? Is it all going to go in the stock market? Probably not. It's probably going to go bonds and some in the stock market. Because when the Fed starts to lower rates, those rates are coming down too. Let's look at dividend payers, small caps, energy, utilities, those underperforming sectors, all the way to international. Jeremy, I'm open for questions. And I think we have some on the call.
Yeah, Graham, thank you for information. We had some questions come in. The first one we had was, do you think the Fed is on a path to lower interest rates? And then I guess the second part of that, how quick, how fast?
Well, that's $1 million question. How quick,
right.
How fast, right? I think the Fed is on a trajectory to want to lower interest rates. Now, how quick, how fast? I think originally they were talking about 3. I think the market was hoping at the beginning of the year maybe about 6. That was too lofty. We said that from day one. I still think 3 is way too lofty. 1 or none this year. Now let's evaluate that statement. Is it bad to not have interest rates lowered? Not necessarily. Maybe bad for certain sectors. But let's think about this. Would you want the Fed really lowering interest rates a lot because they're fearful of the economy moving into recession? Or would you rather them kind of stay pat, kind of where they're at, making sure that inflation is still coming down to some good manageable areas, and then make a methodical step in lowering? I think the latter is probably what's going to work better for the market. But I wouldn't be surprised if we get 1 or 2. But again, I wouldn't be surprised if it's really a 2025 story.
I got you. And then a second one was a piggyback off that same question. What effect do you think that if they do lower interest rates will have on the stock and bond market?
Well, I think, I made a quick comment on that. I think, stocks love lower rates as long as it's not tied to a recession. As long as you have a good gross domestic product, the consumer is still in check, but maybe moderating a little bit. But it's all in check, and we're not going into a recession. I think stocks can do quite well. And I think that would be a recipe for the underperformers, those cyclicals, those small cap, maybe some internationals. I think, and definitely the bond market. Now, I'm not going to paint the picture that bonds should rally and outperform stocks over the long term, because I think we all know that's not really it. But it's been a long time since we've really had an opportunity to make as much income as we can on good, high quality bond portfolios and even high yield portfolios in the municipal tax free market, so on and so forth, and a capital appreciation. So we're kind of in a sweet spot for that. So good diversification, good balance could lead to a next level of outperformance in your portfolio if you're balanced correctly.
Makes sense. And then the last one I had here was, with all the money on the sidelines, do you think where will it go? You know, when they lower rates, where do you think that money will go?
Yeah, I'm a little hard pressed to think it's all going to go in the investment market, because even when the Fed starts to lower rates, you know, if they start lowering by 1% at a time, we got bigger issues, and this market's down to 20+% probably, right? Because that means they're trying to manage a potential recession. We think it'll be moderate as long as the economic numbers hold up. And we think if they start coming down in 25 to 50 basis point increments and then kind of plateau, you know, that's still, you know, okay for the money market accounts, because that's still a lot higher than what they were getting just 3, 4, or 5 years ago, you know. So I think the money will come into the market, maybe a little more into the bond market than in the stock market, because I think people are still going to want to enjoy that risk-less. Well, I hate to say that because everything has risk, or the low risk environment that money markets still present. But I think it's going to come into bonds. I think it'll come into stocks. I think it's another way that can help prop this market going forward. And then the Fed could backstop it if things look worse. So I guess my statement right here would be, do I think this market, I know you didn't ask the question, do I think this market has to have some huge correction? And the answer is absolutely not. I think it can rotate within, because I think we got a lot of tailwind to help this market. Now, does it have to go up a lot from here? No, we've already advanced a lot. Maybe we just moderate and chop around here a little bit. Go ahead.
Gotcha. Well, thank you, Graham. We always appreciate it, Jeremy. So that was the last question I had. And we appreciate everyone that was on the call today. Check us out again for the third quarter. It'll be the last Wednesday of September. So we'll be putting some notices out about that. And check out our social media pages and our website. And always give us a call here at the office if you have any questions. We'll talk to you next time.
Take care.